to do Dataroom in a day. I was to try to get a hook into you so that you'd come and listen to me and see what ALECA is all about. Now, I ran through the slides. It was about 4 hours of presentation, so it was a bit too much, right? I don't think you have 4 hours. So I'm going to try to keep it in under an hour, well under an hour, which means I'm going to have to talk really fast. And I've had lots of caffeine this morning, so I'm vibrating, and I'm going to be talking super fast. What I want you to do, okay, I want you to write down in the comments on the side, you know, the chat box in Google Meet. I want you to write down your question. Yeah, exactly, jitters, exactly. So I want you to write down your comments, write down any questions, and we'll try to address them as we go, or we have your email address, so we're gonna hit you up afterwards and answer any questions, okay? So start with the why. Why are you here? Why are you here? I mean, really, for instance, there's a book, a great book by Simon Sinek, Start with the Why. But everything we do in life is an investment, especially your time here today, whether it's a technical analysis, going to a data room, or whether it's taking training or watching a YouTube video on how to do something. Everything's an investment of your time. Even going to meetings, taking conference calls, even these endless boring webinars like this one, it's an investment. So I'm going to try to respect you and give you as much as I can in this hour, right? How many webinars have you had in the last week, in the last 2 weeks? You're welcome to write in your comments how many webinars you have attended in the past week. And it's something we probably didn't do much 2 years ago. All right, so my goal of having all of you with me today is to break down and structure and evaluation quickly. Okay, so that's great for young professionals. I also want you to focus on both the value of what you're looking at and the sustainability. So a little bit of green. We got to start introducing a little bit of green into what we do in life, okay? Whether it's our personal life or work. And this is the ALECA logo here with sustainability. So actually Ezzah was leading another webinar last week on
sustainability loan. Yeah.
Sustainability-linked loans.
Correct.
And if you're interested in that, you're welcome to go to our YouTube channel and take a look on what that is all about. But basically, the investment world is looking to incentivize or reward companies that have some type of sustainability goals within their investments, okay? So you'll be rewarded with lower interest rates, maybe tax breaks, those kind of things, okay? And then also, we're going to show you a little bit of ALECA. Obviously, it can't be a complete live demo, but I'm going to try to do as much as I can. So let's get started. What is ALECA? ALECA is a toolkit. It's hosted on Microsoft Azure. We've built, over the past 3 years, we've taken a lot of our Excel spreadsheets and a lot of our little tools and a lot of the functionality out of other software, and we've rebuilt it onto the cloud with Microsoft Azure. Now, Microsoft Azure is a very secure place to work. You know, you get a username and a password, and everything you do is structured in an SQL database, and you can access it anytime. You can share it to specific people at any time. You can, it's a full Microsoft product, but it's on the cloud, and we built it from scratch. We've got project management tools in it. We've got a hydrocarbons in place probabilistic calculator. I know a lot of you geoscientists out there have built your own. We've built one as well, but now it's hooked with recovery factor and it's connected to economics. So we go a little further, and it's also connected to the carbon footprint module. So we can do production forecasting and economics. Everything kind of gets connected through economics, including our sustainability modules, okay? So we can calculate the carbon footprint. Training, we give lots of training. We're giving lots of workshops, lots of webinars, but also training in industry that's cost recoverable here in Malaysia. And we're fully registered with the government for cost recovery. And we're also trained as trainers. We all had to take a 5-day training course recently, including Ezzah. So every person associated with ALECA has this training course and is certified as an adult trainer. Of course, we've got the expertise, and we have some of you on the call today are some of our experts. We have you all listed on our platform, and you're available to consult on projects. We can connect you with clients. So that's our global expert network. So Dataroom in a day, not going to mention any names, but somewhere in the world, a national oil company is marketing a field. This happens all the time. This is not news. They're always trying to flog the things that they don't know what to do with. So the Discovered Resource Opportunity, a DRO, it's a nickname for here in Southeast Asia, of course, is a field, and it's the government is looking for you to come in to operate the field as a nimble, agile, low-cost company. Yeah, so maybe some of us can get together and we can grab this asset, and we can be the low-cost oil and gas team. But unfortunately, we got to commit to drill a well. There's the rub, right? So this field has already produced. It's produced it on an extended well tests for about 18 months to an FPSO. They were flaring the gas, of course, when you produce to an FPSO, but they already produced 1.5 million barrels out of a single well. Okay, it's a single well. Here's a map. Here's what it looks like. It's a clastic sand. It's a typical clastic sand in some of these basins, tertiary basins. I won't mention where. Okay, but you have a very small platform. One well, of course, you've got the exploration well. You've got the contact, and it's a pretty nice little discovered opportunity. All right. They think they have about another 2.3 million barrels recoverable remaining here. They have a second zone that looks exactly like this one. They're lookalikes. They have similar maps, similar gross rock volume, similar in place. Okay, but it hasn't been produced yet. And this one, they think you can produce about 3 million barrels. Okay, all right. So you're getting a picture. Is there a picture forming in your brain now? You know, you're kind of getting it. All right, so the OPEX here with the FPSO is about 25 million USD a year. All right, so that's the platform, the FPSO, the whole team. It's about 25 million. To drill a well out here, obviously the government here is asking you to commit. Drill a well out here, it's about 10 million. And the rig moves about 5 million. Water depth, this is offshore. Water depth is, let's say, 60 meters, thereabouts. Depth there is about 7,000 feet, okay, subsea. So you kind of get in the picture now. Of course, there's always risk with drilling a well. We just had a major accident here in Malaysia, offshore Sarawak. A rig, one of the legs collapsed as it punched through on preloading, and the jackup sank. Okay, so it happens. We're in a risky business, and that's part of our industry. We need to understand these things. Of course, there is about 100 meters water depth. Here, we're at about 60 meters water depth, okay? So that's why you do a lot of these site surveys and so on. But that's just an aside note. Just for your information, no one was hurt. Everyone got off that rig safely, and but unfortunately, the rig was lost. And then, of course, you've got decommissioning. You've got a platform, you've got some wells, one well, and maybe you drill a second well. So you're going to have this ABEX, or abandonment expenditure. Okay? Got the lay of the land so far? All good? Any comments? Yeah, sorry, there was a comment there. Okay, Naga 7, that's correct. The Naga rig number 7. If you want to look it up on Google, it just sank last night or the night before. Okay, but no one was hurt. All right, so where do we go from here? What can you do in a day? So that's probably why you're here. You're trying to figure out for yourself what you can do in a day. Well, within ALECA, we've got a lot of tools. So obviously, we're all working from home. We're not working in an office typically, and we're going to try to collaborate via a conference call, right? Some kind of conference call to talk to the team and get little things done. And it's hard to keep the energy up on a project when you're not face to face, you're not talking, you're not having the casual conversations. Everything seems to be a little more structured. And often we find that the real value is between the disciplines. So ALECA is one of those softwares on the cloud that kind of helps people collaborate. You know, the geoscientist with the reservoir engineer, with the drilling engineer, facilities, economics, your HSC department, finance, the economists. I don't think there's one economist on the call today. We got, what, 37 people. There's probably not one economist. Hand up if you're an economist. Yeah, that's what I thought. Not one. Okay, but they are part of your team and they're very important, okay? So obviously we've built some hydrocarbons in place tools. We've built some production forecasting tools. And then we've got some economics tools. Of course, that's where the economist comes in. And we can all work together to start building some of these profiles, whether it's production, costs, those kind of things. We can build those profiles in the economics tools that ALECA has now and do a quick screening. And that's what I'm going to show you today, okay? I'm going to show you how you can do a very fast screening on ALECA. The last but not least piece, it's all kind of linked, is our footprint. If you're going to vent any gas or if you're going to flare any gas, you should really be reporting the footprint now. And certainly a lot of national oil companies are asking for that. So now I gave you what the discovered resource opportunity was. I kind of framed it for you high level. And that data is shared with you in a data room typically, or in a information memorandum. Okay, so which ALECA modules will we be running? Okay, so I think we need to, as a young professional, you need something to frame your work. So we're going to look at a scope of work module where we list every piece of the business. Okay, the oil and gas business, we list every piece. And in there, we're going to select what we want to do. The next piece is to do a probabilistic hydrocarbons in place. We're going to do a production forecast. We're going to run some economics. We're going to look at our carbon footprint. Okay. And then we're even going to think about doing a risk register. How many on the call have done a risk register? Right? We should be doing those in the first day, in the first few hours when we meet together on something to understand. You know, we need to understand. Thank you. At least one person on the chat has. Okay? So, expert report. You get into the data room. Some of the major documents you want to look at is these expert. I'm gonna use one of these expert. There's lots of them out there. I can list them all, but they all do reserves reporting. Okay, you're gonna find that expert report, and you're gonna try to tear it apart and see how they calculated the hydrocarbons in place for that little map and that one development well, and you're gonna try to understand what the range of hydrocarbons in place is. Okay, so you're going to go through that report and you're going to find this. In the report, you're going to find a range of porosities, a range of hydrocarbon saturations, net to gross, oil shrinkage factors, area and thickness. In ALECA, you're going to grab all these numbers, you're going to throw them in ALECA, and you're going to try to duplicate, at the very minimum, you're going to try to duplicate the expert report numbers, and we can do that. This is straight out of ALECA now. Within ALECA, within 30 seconds, you can dump in these numbers and you'll get a P90, a P50, and a P10 on the hydrocarbons in place. All right, so then you can make a judgment call very quickly whether these numbers make sense. You can maybe have a leverage some of your knowledge of the area, look at an analog, look at the map that was given to you, and remember, you only have a day. You only have a day, so how much reading can you do? What's your analog? So basically, within ALECA, you're just going to populate it and rerun it, and you're going to say, you're going to give it a yes or no. Does this seem reasonable? Because the expert report, they spent probably 10 days on it, right? They spent 10 days, and they reviewed everything. And in one day, you're definitely not going to redo everything they're going to do. what you're going to do is you need to talk to the next discipline. You're going to go one leg further on a lot of these expert reports, and you're going to talk to someone else. So from your point of view, you think the expert report was reasonable, you got yourself a pretty good range on in place, and you give it kind of a check mark. Now, I got behind the scenes here. I can show you behind the scenes. I have ALECA. Can you see my screen still? I hope so. Thumbs up. Okay. So the good question, Rhino. The question is, how do we calculate the area? The area and the thickness come out of the expert report. So with all these data rooms, there's always someone that has given the GRV, the net GRV, the gross rock volume, or the area, the thicknesses. They're always in the data rooms somewhere. You just have to read, you find it. And then you try to calculate it. You can also calculate it. We've done it in the past where you can do a rough estimate on the area using a planimeter if you like. We don't have that software. That's not what we do. We're trying to just grab, assimilate things out of the data room and put them in. Yeah, but maybe you have a planimeter, Rhino. Maybe Rhino is a programmer. Maybe he has one, we can borrow his. Okay? But yeah, good question. So here is the site. It's Microsoft Azure. It says at the top ALECA, but it's actually Microsoft Azure. And I'll just log into the platform here, and I can show you relatively quickly because I need to get back to the slides. I don't think you guys have 2 hours. I'm going to go into Dataroom in a day. I'm going to bring up that time, and I'm just going to hit run to show you how quick it runs because we run it 100,000 times on Microsoft Azure. Here it is here. Okay. So here it is here. I put in the parameters here, so you just edit, and you can put in all the parameters. You lock it, and then let's run it 100,000 times. 1, 2, 3, 4, 5, 6 seconds. It's all running remotely on Microsoft Azure server, and it's really fast, and you end up with the results. Okay, so we're pretty proud of the speed of it. We actually have some of our programmers on the call now. Thank you very much, Advent, Darren. A few of the guys have joined us. Thank you. But bottom line is they using Microsoft Azure, you're leveraging the computer power, but also the environment is secure. You can invite your friends. You can get in and do all sorts of things in a secure environment on the cloud. Okay, it's even more secure than your laptop and certainly more secure than our cell phones. So Microsoft is in the business of keeping your data secure. So we're very happy to be in partnership with them. The next piece, you're going to find more expert reports in the data room. Okay, so find them. Their reserves report, the subsurface report, whatever. Tear them apart. Read them, tear them apart with your team. If you've got a geoscientist, reservoir engineer, facility engineer, and economist, work together. But basically, you're going to find some more terms where someone comes in as a senior reservoir engineer and he's going to give you some kind of decline rate, a range, and he's going to give you some profiles, okay? Or she is going to give you some profiles. At ALECA, we can take all these numbers and recalculate, rebuild that range, and we have, again, a probabilistic calculator, and we have another webinar coming on, sorry, Ezzah, when is the next webinar?
Oh, it will be on May 20th.
May 20th. So on May 20th webinar, we're going to go in detail on our DCA tool and our recovery factor tool. I'm going to glance over them quickly here, okay? The first one is the expert report can be duplicated right in ALECA, so that gives you a bit of a check mark. You can kind of understand what they put in, and you can get the same numbers. So that gives you some confidence that you found the right spot and that there's no errors within their reporting. The next piece is you can get a profile. Now, I got 3 numbers here. I got 3 profiles, okay, based on the expert report. Do you guys remember what the reserves were on the first page? What was the what was the remaining reserves? Does anybody remember what the number was from that 2.3? Who wrote that? Farida. Hey, pretty good. Yeah, there we go. Okay. Yasmin, Farida, well done. Yes, it was 2.3. So now when you dig into the reporting in the data room, you find that what? The 2.3 is what? It's the high end, isn't it? Okay, well, obviously, if you're trying to sell something, you're going to put your best foot forward. You're going to say it's the high end. Of course, you're going to do that. You're never going to show the low end. But now, at least, you have the range. You've duplicated things, but so that's a positive sign. But now you know. Now you know the 2.3 is the high end. You kind of knew it already because it's always like that. However, if you look at the decline for all the reservoir engineers out there, if you look at the decline of 0.2, 0.3, 0.4, and you remember the production rate on that first page I showed you, you know that the production rate went from like 4,500 barrels a day down to 2,100 in like a year. Well, that's not 20, 30, 40% decline. That's more like 60%, okay? And we have another tool. I don't have time to show you that one, but we have another tool where you can back calculate using data and back calculate what the decline is. So I think if I were to look at this going forward, it's a red flag. Okay, it's a red flag. Why is it a red flag? Because the expert used very small amount of decline when the production data in the past showed 60%. Okay, so I'm not saying it's wrong. I'm just saying it's a red flag. In a data room in a day, you just may not have time to solve this. Okay, you got to keep going. You only got a day, and look at all the reports you got to read. Okay, and you got to frame, and you got to keep going forward. So we're going to keep going forward, but we've got a red flag here. The next piece is how you bring these two things together. How do you bring the hydrocarbons in place that you've calculated? You've got a big range. And how do you bring the forecast tool that you just populated as well and calculated? How do you marry them? We found a way to kind of get them married in this recovery factor matrix. I'm going to walk you through this, okay? We've got an entire webinar planned on this, so if you go away confused, come back on the 20th, okay? All right, so along the top, we've got the forecasts, and we've got a P90, which was 1.9, P50 at 2.1, and P10 at 2.3 million barrels of remaining to be recovered. On the other side, I've got my in-place numbers from my calculator, and I got 6.8, 8.7, 11.2. Now, the host government is telling you you're going to get 2.3 million barrels, which is this column here. And based on your hydrocarbons in place, that means your recovery factor is going to range from 56 to 33, okay? So what do you do? Is that really reasonable for a field this size, a clastic? It's depletion drive, the pressure's coming down. There's only one well in one square kilometer. Is this really reasonable? And to me, when I see these kind of recovery factors for a one well wonder, it's a bit of a red flag. So we got ourselves a second red flag here. Okay, I can't solve this in a day, and neither can you with the information I'm giving you, although you're welcome to let me know. Okay, is this a recovery factor is in percents? Yes, it is, sir. Yes, it is in percents. And thank you, Gordon. You're saying what, 15%? Yeah, I mean, one well wonder, it's like 25 to 35 in that neck of the woods, right? So here we put in the existing production, right? Remember that there's already existing production, so we add that in, plus we add in the recovery factor here, okay? All right, so that's, come back on the 20th and we'll show you all those great modules. Show them all to you, and it would be great to have you with us. Okay, so now that we did hydrocarbons in place, we're moving fast. Remember, data room in a day, and now I'm stuck. I gotta do this data room in like 30 minutes, all right? So I'm gonna remind you once again, the well's already done 1.5 million barrels. we got ourselves some profiles, although they're not 2.3. 2.3 is the high end, the mid case 2.1, and then we've got ourselves some costs. So what now you need to do, I'm going to go back to ALECA, so I can just show you real quick the reservoir engineering, the production side. This is our forecasting tool where I built all of the profiles in here, which was the last rate the field did, and here's what they put in, the 0.2, 0.3, 0.4. These are the profiles. You can look at all the profiles, or you can just look at the P90, P50, P10, and you can look at them in a number of ways. You can look at them from a cume production point of view. You can look at them from a production per increment point of view. All these numbers can be exported. All these numbers can be connected to the econs now. Of course, we have downtime. I always put in 10%. It's kind of a great industry average. Why not, right? 10% downtime, that's important. The piece below now is our recovery factor matrix. And this is where we connect the NP. Any reservoir engineers out there? What's NP? The existing production plus the forecasted production, and then you get your recovery factor, and these are in percents, correct? Okay? But now I'm going to go to the econ evaluation, okay? So I'm just going to open it up. Now I've already populated it because it takes like a couple minutes to put in all these numbers. All right, so I've got kind of a do nothing case, all right? So this is the first case I'm going to show you. And do you remember what your operating cost was for the FPSO? Anybody? $25 million. All right. So 25. Thank you very much. At least there's one person not sleeping. $25 million. Thank you very much. Now it says here it's 27. What else is there? There's the abandonment. There's abandonment. You have to commit to some type of abandonment every year. And we said $2 million a year for 5 years. But if you look at this now, if you look at the second year of getting this field back up and running on an FPSO, you have about a cume cash flow of about $6.6 million. And the next year, you've lost $5 million of your cash flow. Okay, so you would probably abandon this, or you wouldn't go further than 2 years. Okay, because that's what the government kind of thinks it's worth. And oh, by the way, the downside, the low-end production is still positive. It's 1.1 million, okay? So I've built already all the scenarios, and I'm going to show you the second scenario here in ALECA, where you can come in and say, okay, well, you know what? I've got my operating expenses here, 25 million. Do you see that? 25 million. I'm going to shut that off, and I'm going to put in a pipeline because I think that might be worth more. And I'm going to turn on my pipeline operating expenditure because it's less, but then I need a capital expenditure. I need my pipeline expenditure. So I'm going to just turn that on in a second, give it a minute to refresh. That's my pipeline. And let's see if that still makes money too. Now what I'm doing is I'm running extremely high level screening. My oil price is $54. Okay, if you are interested in oil price. I ran 54, which is basically a $60 flat oil price. And then I reflect the 10% royalty because there's a royalty in this particular neck of the woods, wherever this country is. There's a 10% royalty. So then you can just run it at 54 and you get a high level screening. So what happened to our economics at this point? Here's the cume cash flow. Obviously, you're spending capital. You spend capital in the first year, and then all of a sudden it starts getting positive, and it peaks out somewhere in here at $6.4 million in year 4. So you get an extra 2 years. The net present value of it is still pretty low at 6.4, but you've now captured all that gas and you've pushed it down the line, and hopefully it gets sequestered, it gets used in some way, and it's just not flared. Sound good? All right, I'm going to go back to my slides because I'm running out of time and you guys are going to get real bored of my voice. So I put all this in, and now I ran the base case which is don't drill a well, just get the field back up and running, and we saw that it's worth 6 million or so. We put in a pipeline in order to conserve the gas, and again, we didn't drill the well, and we got it running. The third one I did was we drilled a well, and I'll show you that in a minute in the summary. So this was the summary coming straight out of ALECA, where you have your inputs. You got a minimum most likely and a maximum. You've got the cash flow cum, okay? And within 2 years, you were starting to lose money. So that was the do nothing case, okay? So obviously this is dominated. This case is dominated by this big $25 million a year going in. And that's a red flag. Obviously, if you drill a well and it's unsuccessful, you're going to be in trouble because the base case dies after 2 years. So can you get this 25 million down? That would be a challenge to you, and that might not be a one-day affair. You might need to engage someone to help you do that. Next, we said let's conserve the gas. And obviously that was a bit capital intensive in the first year. Okay, fair enough. But then your operating cost is less because you don't have an FPSO out there, do you? All right. So now you've extended it out to year 4. Okay. And it's still worth about $6 million. Okay. But you can feel better about yourself because, hey, you've conserved all that gas. Okay. So that's a great thing. Now, the pipeline reduces greenhouse gas emissions. I think that's a big win for the country and for the world. But now, if you look closely, your low case production, which is in yellow, it never goes above the 0 line, does it? So you lose money. So if your production comes in on the low side, on this one you lose money. Okay, it's a red flag. Now I'll go back to the other one. Maybe you didn't notice that on the other one. On the other one, the low case production scenario actually stays positive in the second year. Okay, on this one, it never makes it. So it's something to consider. The minimum case is negative, and a lot of leadership teams, they focus on the train wreck. What's the worst case scenario? What's the worst case scenario? That's all they want to know about. So that yellow line should try to keep it above the 0 mark, okay? Next, conserve gas and drill a well. So now you're going to spend a lot more money. You're going to put in a pipeline and you're going to drill a well. So obviously your cum cash flow for the first 2 years is underwater. You've got some revenue, fantastic. The field is producing, fantastic. But you're spending so much that your cash flow is actually negative the first 2 years. All right. But then the third year, once that well is on, you're making money. You're making money, and it doesn't matter about the terms. You know, we debate about, well, is it a PSC? Is it a small field? Is it a royalty scheme? What is it? Actually, doesn't matter. You can make it work. You can make this work. Okay. The other stuff that's marginal, the government knows it's marginal. So you can negotiate great terms. But if you got this in your back pocket, the government knows you have this in your back pocket as well. So that's what you're negotiating on. How much of that is going to go to you? How much of that's going to go to the government? Okay, if you're dealing with a national oil company and you're in partnership with them. Got it? Any questions? No questions. All right. So obviously this is very robust cash flow, and even the minimum case is positive. And I think drilling a well and getting that, extending the life beyond 5 years even, you're going to make money, okay? But how much are you ready to risk at the beginning? So now you've done 3 scenarios very quickly. The other piece I want you to look at is conserving that gas and sustainability. At ALECA, we have the carbon footprint calculator, and I have the programmer on the call here. Yes, sorry, Rhino asked a question. Can you test the sensitivity of your 2 red flags? Yeah, you can actually. We have a way to, in the economics, to put in better ranges. I was putting in a lot of 1 numbers, but now what you should be doing is looking at the inputs, going back, rebuilding either the hydrocarbons in place, you know, bump it up, or really look at that decline. And we have another tool. I have some slides I cut out, but the decline is not 20, 30, 40, it's more like 60. So the forecast coming out of this well is a bit optimistic. Okay, so I've got another whole other set. Maybe we'll go through that on the 20th. Okay, so you're welcome to join on the 20th. But the carbon footprint calculator, this is straight out of ALECA as well. If you remember, we were producing 1.4 BCF from the first well. We're going to get another 1.5 BCF from the second well, and collectively that's 2.9 BCF. That equates to 525,000 tons of CO2 that with a pipeline, you get it over to the infrastructure. Hopefully, they can do something with it. They can use it for power at least, or they can inject it and get more oil or sequester it, okay? So there's a lot of good things going on with the pipeline, even though it doesn't add value perhaps, but in this case, it adds sustainability, which should be equally weighed. Okay, so all these red flags, you mentioned it right there. Is there anything we can do with the red flags? You can now build it into a risk register. Thank you. This was a good lead-in question to the risk register. Do you remember what your red flags were? Anybody? You want to write down? Anybody want to write it? Yeah, what were the red flags? What was the first red flag? Ezzah, you remember?
Yeah, Frida mentioned the RF. Recovery
Profile
factor.
and decline, recovery factor, correct. And profile and the decline, correct. So the annual decline was a bit of a red flag. We're going to work on that. And the recovery factor, so the marriage of that geoscientist and that reservoir engineer. It's a love-hate relationship, isn't it? Absolutely love to hate them. And I don't know which side of the fence I'm on anymore. Yeah, STOA, right. I mean, you want to bring one up and you want to bring one down. What was the other one? The OPEX, 25 million a year for that FPSO. Can you get that down? Is there a way to manage to bring that down? The pipeline case is still marginal on the downside. So could you get your pipeline costs down? Could the operating costs be less? Yeah. All sorts of things you can try to do, and maybe it's not a one day thing. Maybe you'll have to spend a few days, okay? But the ALECA risk register module, which we've built it, you're gonna populate things that can affect your project and how likely they are, and then how much time do you invest in the mitigation of it, okay? So it's an investment. You're gonna have to hire an expert. You're gonna have to study it and really sharpen your pencil to get it down, right? So what is the mitigation? Do you want to meet with vendors and get pricing down? So do you need an expert? Of course, you can always hire someone through ALECA. We've got a few on the call today, okay? So going forward, a risk register is a great place to frame the next part of what you're gonna do after you've spent a day. Okay, so what do you communicate to the leadership team at this point? Okay, you've worked a day, maybe you've worked with your geoscientist, reservoir engineer, you've worked with your economist, you got some of your HSE people involved, you did a carbon footprint tool, right? After one day, you're gonna communicate the 3 cases, what the undiscounted kind of mid-case cum cash flow is. So it's 6.7, 6.5, but this one's better because you sequester all that gas. And then a new well is worth a fortune. It's worth a fortune. How much of that can you negotiate and become part of your business? Because dealing with national oil companies, they're going to want the lion's share of that. Okay? So now that's where your negotiating skills come in. But every oil company I've ever worked for, every client I've ever worked for, they're always interested in your CapEx, capital expenditure, OPEX, your operating expenditure, and your abandonment expenditure, your ABEX or decommissioning. And in this case, we've got 3 scenarios, right? We've got don't spend any money, just get your hands on that field, don't spend a cent, get in and get out as quick as you can and make yourself some money. You've got one where it's a little more sustainable, you want to conserve, and you've got another one where you go in deep, right? You bring in, you drill some wells, you put in a pipeline, you're going in pretty deep, right? $40 million for a small field. But the opportunity is there, and you leave it up to someone else. You know, on the leadership team, you present this as a young professional or as a consultant. You present this to the company leadership team and say, do you guys have a vision? Do you have a long-term vision? Is this something you guys want? Before we spend a month on this, right? We spent a day. You tell us if we should spend a month on it. And then they'll take a look at it, and it either fits or it doesn't. So it's a wonderful screening tool if you use ALECA, okay? Any question? High side, okay, I.e. the high side, no, okay. Right out, factory, recovery factor, okay. No questions? Any questions? You're welcome to throw questions at me because I'm done. I managed to get through it in about 40 minutes, not too bad. Got it down from 2 hours to 40 minutes, okay? Any questions? The next one is on May 20th. If you're really curious about our DCA tool and our recovery factor, how we marry a geoscientist and a reservoir engineer, I'm thinking of a picture, you know, arm in arm, bride and groom, a geologist and a reservoir engineer. Wouldn't that be pretty? You guys will sign up for that, right? Or maybe not. You guys will run and hide. But when you think ALECA, okay, think sustainability.